Welcome back to the channel. Today we're diving into the world of dividend stocks and how you can maximize your profits to build long-term wealth. I'm talking about generating passive income, watching your money work for you, and building a solid financial future, all through the power of dividends. We'll be exploring 10 crucial aspects of dividend investing, from understanding the basics to uncovering hidden gems in the stock market. Make sure to hit that like button and subscribe for more financial tips and investment strategies. Let's get started. Investing can seem like a jungle full of confusing jargon and risky maneuvers, but dividend stocks are like a calm oasis in that jungle. You buy a share and the company shares its profits with you as dividends. It's like getting a paycheck just for being an owner. Dividend stocks manage risk and maximize returns. They tend to be less volatile than growth stocks. Dividend stocks generate passive income. Imagine relaxing on a beach and your dividend payments are rolling in. With the right knowledge, dividend stocks can build long-term wealth. All right, let's talk numbers. When it comes to dividend stocks, there are two key metrics you need to understand: dividend yield and payout ratio. Think of dividend yield as the interest rate on your savings account. It tells you how much cash a company pays out in dividends each year relative to its stock price. To calculate it, divide the annual dividend per share by the current stock price. For example, if a company pays $2 in annual dividends and its stock price is $50, its dividend yield is 4%. Now, a higher yield might seem tempting, but don't get blinded by the numbers. It's crucial to look at the payout ratio as well. The payout ratio tells you what percentage of a company's earnings is paid out as dividends. A high payout ratio over 90% could be a red flag. It might mean the company is stretching itself too thin and might not have enough cash flow to reinvest in its growth or weather a storm. On the other hand, a low payout ratio below 50% indicates that the company has room to increase its dividends in the future. So aim for a sweet spot, a reasonable dividend yield combined with a healthy payout ratio. A sustainable dividend is far more valuable than a high but risky one. Now let's talk about turbocharging your dividend income with the magic of compounding. And the secret weapon here is dividend reinvestment plans, or DRIPs for short. Think of DRIPs as your personal dividend growing machines. Instead of receiving those dividend payments in cash, DRIPs automatically reinvest them back into buying more shares of the same stock. It's like a snowball effect. Your dividends buy more shares, which generate more dividends, which buy even more shares, and on it goes. The beauty of DRIPs is that they allow you to buy more shares without paying any brokerage commissions. That's right, free money. Plus, they take the emotion out of investing. DRIPs are especially powerful in the long run. Over time, even small, consistent reinvestments can significantly boost your returns. Now, not all companies offer DRIPs, so it's important to do your research. DRIPs are a fantastic way to supercharge your dividend income and build wealth over the long haul. Chapter 4. Past Performance Matters. Dividend Growth History. When it comes to dividend stocks, the past can be a powerful predictor of the future. That's why it's crucial to look at a company's dividend growth history. Companies that have consistently increased their dividends for years, even decades, are like the marathon runners of the stock market. They've proven their ability to go the distance. But here's the thing. Don't just look at the number of years a company has increased its dividend. Pay attention to the rate of growth as well. By looking at a company's dividend growth history, you can get a sense of its financial stability, management's commitment to shareholders, and its potential for future dividend growth. Chapter 5, the dividend aristocrats, kings and queens of consistency. Now let's talk about the creme de la creme of the dividend world, the dividend aristocrats. These are companies that have achieved dividend royalty by increasing their dividends for at least 25 consecutive years. Talk about consistency. Dividend aristocrats are like the blue chip stocks of the dividend world. They're often well-established companies with strong competitive advantages and a long history of profitability. Think of companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble, household names that have been paying and increasing dividends for decades. Dividend aristocrats aren't about flashy growth or overnight riches. They're about slow, steady, and reliable dividend growth year after year. Investing in dividend aristocrats is like building a solid foundation for your portfolio. They provide stability, income, and peace of mind, knowing that these companies have weathered economic storms and emerged even stronger. Chapter 6. The taxman cometh, but not as hard. Tax advantages of dividends. Let's face it, nobody likes paying taxes. But guess what? Dividend income often gets a more favorable tax treatment compared to ordinary income. That's right, the taxman might be knocking, but he's knocking a little softer. You see, dividends are typically taxed at a lower rate than your regular income. This is because the government wants to encourage long-term investing. So they give you a bit of a tax break to sweeten the deal. Now, the exact tax rate you'll pay on your dividends depends on a few factors like your income level and how long you've held the stock. But generally speaking, qualified dividends, those paid by US corporations, are taxed at a lower rate than your marginal tax bracket. This tax advantage can make a big difference in your overall returns, especially over the long term. Dividend stocks can offer a significant tax advantage that can boost your after-tax returns. Chapter 7. Funding your golden years, dividend stocks and retirement. Retirement might seem like a lifetime away, but trust me, it sneaks up on you faster than you think. The good news is that dividend stocks can be your secret weapon to funding your golden years. Imagine this, you're retired, sipping margaritas on a beach, and your living expenses are covered by a steady stream of dividend income. Sounds pretty good, right? That's the power of dividend stocks in retirement. You see, during retirement, your investment goals change. You're no longer chasing high-growth stocks. You need reliable income to cover your living expenses, and that's where dividend stocks shine. They provide a consistent stream of passive income that can help you maintain your lifestyle without having to sell off your investments. Plus, as inflation rears its ugly head, dividends can help you keep pace. Now, I know what you're thinking, Graham, should I put all my money in dividend stocks? And the answer, my friends, is a resounding no. Investing solely in dividend stocks would be like only eating vegetables. Sure, they're good for you, but you need a balanced diet. The same goes for your portfolio. You need a mix of both dividend stocks and growth stocks. Growth stocks are like the dessert of your portfolio. They offer the potential for higher returns, but they also come with more risk. They're typically younger companies that are reinvesting most of their earnings back into growing their business. So how do you find the perfect balance? It all depends on your individual goals, risk tolerance, and time horizon. If you're young and have a long time horizon, you might tilt more towards growth stocks, but as you get closer to retirement, you'll want to shift towards a more conservative approach with a higher allocation to dividend stocks. The key is to find a balance that works for you and your financial goals. Have you ever heard the saying, don't put all your eggs in one basket? Well, the same principle applies to dividend investing. You don't want to put all your money in companies from the same industry or sector. Why? Because different sectors perform differently in various economic conditions. For example, during a recession, consumer staples companies like those selling food and beverages might hold up better than cyclical companies like those in the automotive or travel industries. By diversifying across sectors, you're spreading your risk and reducing the impact of any single sector's poor performance on your portfolio. So when building your dividend portfolio, make sure to include companies from a variety of sectors. Don't just load up on energy stocks or healthcare stocks. Remember, diversification is key to long-term investing success. All right, so you're ready to start building your dividend empire. But with so many stocks to choose from, where do you even begin? Don't worry, I've got you covered. First and foremost, do your research. Don't just buy a stock because someone on social media told you to. Take the time to understand the company, its business model, its financials, and its dividend history. Look for companies with a strong track record of profitability, a healthy balance sheet, and a history of consistent dividend growth. These are all signs of a financially sound company that's committed to returning value to shareholders. Next, consider the company's future prospects. Is the industry growing? Does the company have a competitive advantage? Is the management team experienced and shareholder-friendly? These are all important factors to consider when evaluating a company's long-term potential. Finally, don't be afraid to seek professional advice. If you're feeling overwhelmed or unsure where to start, a financial advisor can help you create a personalized dividend investing plan that aligns with your goals and risk tolerance. Thanks for watching. If you found this video helpful, don't forget to give it a thumbs up and share it with your friends. Let me know in the comments which dividend stocks you're investing in. Remember, building wealth with dividends takes time, research, and a bit of patience, but the rewards, like passive income and long-term growth, are well worth the effort. And as always, happy investing.